All right, so looking at the U.S. markets, Greg, we did see a bit of a pullback yesterday, of course. The S&P and the Nasdaq both pulling back nearly 1%. But still, the markets sit at an oversold place. If you look at the RSI, the major indices are still over 70. Do you look at indicators like that? How do you view just the idea that this market may be overbought?
Yeah, so we pay less attention with a long view to the short-term indicators and more about the dynamics and the structural vectors that we think will power it over the next 6 to 12 months. And I think the market is in a surprising place for people who look at those sorts of things. It seems to be, with regard to tariffs, we've taken the attitude that it could have been worse in terms of our optimism, which ignores the fact that there's still a real impact, even if we were to pause today, moving from a rate of around 3% average tariff to around 14% average tariff. And so that's going to shrink GDP. But that causes meaningful inflation to consumers. The labor market has held up rather well. We saw unemployment shrink from 4.2% in May to 4.1%. As we continually take workers out of the workforce, that's going to be inflationary. So I think, we can look forward to a few surprise moves in this back half, including decelerating earnings growth, Frank.
All right, so you're concerned about decelerating earnings growth. We were just showing just a bit earlier the moves with the dollar since August the 2nd. The weakness in the dollar, a lot of people see that as a tailwind for earnings. What's making you so concerned when it comes to earnings? We haven't seen any really meaningful slowdowns in economic activity here in the U.S.
Yes, we haven't. And like many things right now, Frank, just because we haven't seen it yet doesn't mean that it's not going to happen. So when you look at the earnings expectation for the S&P for second quarter, it started on March 31st at around 9%. Right now we're at about 5%, and that would be down from 12.9% earnings growth we saw in the first quarter. It'd be the slowest quarter we've seen since the fourth quarter of 2023. I think that the argument right now, Frank, is not that we will see some slowing. The question is by how much. And so, a lot of that will depend on what the ultimate tariff rate is. We still don't have that. We expected to have that on July 9th. Now that's been pushed to August 1st.
Okay.
But that in and of itself leads to some indecision with business spending.
All right. So, Greg, again, markets are still very close to their all-time highs, still pretty close. Right now seen as overbought. Where would you put money to work? What sectors would you stay away from? Just kind of give us a clear thesis of where, if someone wants to put money to work, where they can put it to work, and maybe where you might want to take profit or just stay away from.
Sure. And we've already alluded to this to some degree, Frank. Follow the earnings growth. We're going to see certain sectors more exposed to tariffs, more exposed to consumer wherewithal and consumption. Those will slow more so than those that are more prone to business spending, more insulated from tariffs, more insulated from wage increases. So we'll see a bifurcation where we see the cloud businesses, where we see the applications businesses, where we see healthcare, where we see defense and government spending. Those businesses will grow by double digits, while others will shrink by mid-single digits. When that happens, the market will bifurcate. Follow the earnings.